Cran. I am a real estate agent here on Oahu, and I'm servicing all islands.
And my name is Rylan Maddox. I'm a loan officer licensed for the state of Hawaii. I'm also serving all islands and reside here on Oahu. Mainly what my job is as a loan officer, loan originator, is I help people figure out how to qualify for the loan. So reviewing their income, assets, their financial liabilities, and trying to fit them into a loan product. So there's many different loan products. Each one is unique or kind of crafted for a specific person or scenario.
Okay.
And that's my...
Can you tell us just what are a few things that is needed to be pre-approved?
Yeah, so to be pre-approved, you have to get an application submitted with the loan officer. Most loan officers nowadays have an online app that you can fill out, or they can take your information over the phone or in person. You're going to be giving things like your residency history for 2 years, your employment history for 2 years, how much money you have in the bank, in stocks, assets, and any liabilities or monthly debts you have. That's the bulk of it. And then once you have that application in, the second part of a pre-approval is the documents. So things like your pay stubs, your W-2s, your driver's license for identification. Depending on your financial situation, it can be very simple and straightforward. Or if you have a lot of rental properties and you own a lot of different companies, it can get more complicated because you have to produce all of those tax returns and statements and such. So it's very individual based on the person.
What's the difference between pre-approved and pre-qualified?
The biggest difference between a pre-approval and a pre-qualification is a pre-qualification is based on stated facts. So you still need to turn that application in, and usually a credit report is run, even on a pre-qual. But it's the customer or the borrower stating how much they make and what their debts are. Pre-approval means that the loan officers verified those amounts with documents. So they have seen the pay stubs, they've seen the tax returns.
Okay, gotcha. Okay, and then what are some of the loan packages for like a first home buyer?
So first-time home buyers typically are going to fall into either a VA loan, which is reserved for service members or individuals who have served in the United States military or other qualifying branch. The easiest one there is like the USS Mercy, which is the big hospital ship. Not necessarily a military member, but those nurses and doctors on that ship are entitled to VA loans, as well as like NOAA and some other organizations. So the VA loan is a zero down payment. For those that qualify for it, it's a very good first-time homebuyer program. For those that aren't military service members, the other zero down program is a USDA loan. That is a loan that it is backed by the government, and it was designed to allow people to more easily purchase land in rural areas. So it does have to be in a certain geographic area, and it's publicly available. You can go to USDA and search their map and see what homes would be approved. It is a zero down program, and it has its own version of mortgage insurance, which we'll talk more about later. And then the other programs that a first-time homebuyer would probably fall into is an FHA loan, which is a smaller down payment. It starts at 3.5% down. And then conventional loans are your pretty much like anything else loan, and those start at around 3%, but the better interest rates in terms are 5% down. And between those four is typically where your first-time homebuyer will fall into.
Describe like a conventional loan versus a different loan.
So a conventional loan is more or less anything, as weird as it is to say, anything that doesn't fall into one of those other buckets. It's kind of like your traditional vanilla loan. It doesn't have the most flexible of guidelines, but it doesn't have it's not the most strict either. So it's kind of like your just average run-of-the-mill. FHA loans are, here in Hawaii especially, we have a lot of what are called CPRs or condos. And so for FHA, USDA, and VA, those projects have to be approved.
I see.
So conventional loans are really helpful because they don't need the condo to necessarily be on that approved list.
Okay.
They do go through their own qualification, but whenever we're working with first-time homebuyers especially, we're looking at that 3.5% FHA or that 3 to 5% conventional. If they're looking for townhouses, apartments, and condos, we're probably looking more towards conventional because a lot of those buildings aren't FHA approved.
Gotcha. Can you talk about like maybe loan packages mostly for investors?
Yeah, so investor loans get a little bit trickier or more creative because what we're looking at there is a loan product, I guess, that you would call portfolio. And what that means is conventional loans are backed by the public. So if you've ever seen the movie The Big Short or you've heard of Fannie Mae and Freddie Mac, those are called mortgage-backed securities. They're publicly traded. And that basically means the group of mortgages are backed by people investing in mortgage bonds. USDA, FHA, and VA are government-backed mortgages. So the government is basically insuring those or backing those mortgages. For investors, it's pretty much whoever wants to give them money. So think of like a private individual or group of individuals that have hundreds of millions or even billions of dollars, and they decide that they want to give loans to real estate investors. So they give out products that are called portfolio loans, and there's anything from your traditional put money down and qualify with your income to what we call debt service loans, where the loan doesn't consider the individual's doesn't consider the individual's income or liabilities. It only looks at does the property's rent pay for its own mortgage. So the property can qualify all on its own. Those are really good for individuals or borrowers that have maybe a lot of other properties or really complicated income. We leave all that out and we just look at the rental potential, sort of like a commercial loan would look like.
I see.
And then the other type of investor loans would be like bank statement programs, where same thing, we avoid the tax returns if they write a lot of stuff off or they're overly complicated and they don't want to produce all those documents. They can just show bank statements for 12 months and we can calculate their income based off their deposits.
Okay.
So those are two of the most popular investor loans.
Okay. Someone should not do during the loan process?
Sure. So leading up to the loan and especially during the loan, you don't want to open new lines of credit. So a lot of home buyers, they're excited about their new home and they go into the furniture store or so on and so forth, and there's for 10% off they can open a new credit card and charge their new furniture. That's the last thing you want to do. Anytime you open new lines of credit, it has to be reviewed. And if you open a new line, we also have to verify what the monthly payment's going to be on that new debt. And with a lot of new lines of credit, you may not get that statement for a month or two. So it could delay your closing possibly, or in cases of if you go out and buy a new car, which we've had some borrowers do every now and then, it could cause you to not qualify for the loan anymore. So new debt is especially bad. Depositing large amounts of cash. So if you have money saved up at home, cash under the mattress, literally, you want to avoid putting that into your bank account because all money that is being used in a real estate transaction has to be sourced. And if we can't source cash, we can't use it, and that could cause you problems. So a lot of people that save money up at home, you want to get that in your bank account as soon as possible if you plan to use it on a house in the future.
If say, for instance, like my dad or my sister wanted to give me like a large amount of money for like a down payment, is that possible?
Absolutely. The only time that monetary gifts usually aren't allowed is whenever it's an investment type purpose. So investment loans don't allow monetary gifts at all. Usually needs to be a primary residence sort of situation. And if it is a primary residence, but it's multi-unit, so like a 2, 3, or 4 unit property, then there's what's called minimum borrower contributions. So the borrower has to bring in at least like 5% down of their own funds, and they can get gifts for the rest.
Okay.
But on a primary residence, single unit, like your typical single family home or condo apartment, monetary gifts from family members especially are perfectly fine. And some loans like FHA if you can show family-like relationships. So if you have a family friend who's been around your family all your life but isn't a blood relative, and you can show that to an underwriter with photos or the story, they can give you gifts as well. So it's not supposed to be set up for a private investor to come hand you money to buy a house for themselves, sort of thing.
I see.
That's what they're trying to stop.
I see. Okay.
There are situations, especially here in Hawaii, we have a lot of family overseas, or family members overseas for buyers that are buying here in Hawaii, and they do keep their money in cash. They either don't have a local bank or they don't like to use the banks. It's very typical out here. And so whenever a buyer is receiving a gift, what we advise them to do is for the family to give the gift money directly to escrow and not deposit it into the buyer or the client's account. And the reason for that is any money the buyer receives directly, so say that mom and dad gave our buyer a gift, and then the buyer gives that money to escrow, because it went into the buyer's account first, we have to source those funds. And so then we need to see the buyer's bank account and also mom and dad's bank account. But if mom and dad give the gift and give it directly to escrow, it's just one of the ways the rules work. We don't need to see mom and dad's bank accounts. We don't need to see where that money came from. We're just taking them at their word that it was legally acquired funds, and there's no further documentation needed. So if you are going to receive a gift, you don't want to receive it directly. You want to receive it into your escrow account through the purchase.
Yeah, that makes sense.
So, private mortgage insurance is effectively just a tool that lenders use to offset their risk. So anytime that you're putting down less than 20% down payment on a house, the lenders consider that a risky asset. If you were to stop making payments for any reason, the bank has to, in order to get their money back, reacquire the property from you, which may cost money, and then resell the property, which probably will cost money. So anytime you don't have 20% down, there's some type of offset for risk, which is private mortgage insurance. On FHA and USDA loans, which are those government-backed loans, it shows up in two ways. It shows up in the form of an upfront mortgage insurance, so it's just an amount added on top of your loan as a one-time fee. And then there's also monthly mortgage insurance that you pay for USDA and FHA, in most cases for the life of the loan. Conventional loans have private mortgage insurance, but it can fall off once your property reaches that 80% equity. Naturally, it usually occurs around 10 years. So it takes about 10 years to fall off naturally. But if your house appreciates or you pay down the loan faster, you can request the mortgage insurance be taken off early. And then VA loans themselves don't have mortgage insurance per se monthly, but they do have what's called a VA funding fee. And it acts the same way as that upfront mortgage insurance, where it's a fixed amount, one time, added on top of your loan when your loan starts. And for the VA loan, that goes and is paid to the VA to offset their risk, since what the VA is doing is telling lenders that if someone does default on a mortgage, the VA is going to cover 25% of that loan amount. So even more so than the normal 20. And that's typically also the reason why VA interest rates are a little bit lower than conventional and FHA. It's a quote-unquote safer loan product for the lender.
Okay.
So the most important part is don't be afraid to get started. Don't be afraid to find out where you're at. If you're talking to a realtor or if you're thinking about buying a home, we know where you want to be. You want to be a homeowner. And in order to get you there, we have to figure out where you're at. If you're not if you're not ready to buy a home right now, a good loan officer can help give you a plan to get you there. But you got to start somewhere. And if you're working with most reputable loan officers, there's no cost to getting pre-approved and there's no obligation. So finding out where your credit's at, finding out what roughly your buying power would be and what debts do and don't have to count against you is a great first step. So if you're worried that your credit's not that great or that the loan officer's not going to be able to approve you, we don't judge. We're here to help people and guide them to homeownership. If you're ready right now and everything's great, awesome. But if you're not, we can help kind of give you that plan.
So how long does the loan or the pre-approval last?
Yeah. So pre-approvals on the letter, they're going to say usually 60 or 90 days that they're valid for. But the truth of the matter is that the pre-approval is good for as long as your situation is the same. So as long as you are making roughly the same money and have roughly the same debt, you're probably still pre-approved for the same amount. If you're actively shopping and submitting offers, though, the loan officer is probably going to want to keep your credit up to date at least every 90 to 120 days, 3 to 4 months. When you're in contract, when you're actively closing on your house, all of the documents have to be within 60 days. So usually they want things updated within like a month or 2 months max.
Okay.